Okay, so hi everyone. It's really a pleasure to be here. Thanks so much for inviting. So what I'm going to be presenting today is joint work with Alberto Sepúlveda, who is at the CMF in Chile, and his work on a large reform to the credit market that occurred in Chile in 2013 that essentially decreased price caps, which is known as the TMC, right? Tasa Máxima Convencional. And the idea is going to be to look at that reform and then to build a framework to think about the trade-off between consumer protection and credit access around that reform. Okay. So a basic piece of motivation for this paper is, just the vast size of these markets. If you look at the cross-section of countries, according to the IMF, the ratio of household debt to GDP is on average 40%. And there's two views about that. Some people argue that there's under borrowing, so that that ratio would ideally be higher, and that could be, for example, because of market power or because of adverse selection. And then other people argues that there is over borrowing, either due to moral hazard or to behavioral biases. Regardless of the view, there's been substantial policy concern over the recent decade, and particularly so after the 2008 crisis. And that has motivated substantial new regulation with limited evidence on its effects. Okay, so there is now a lot of ongoing research in terms of understanding what the policies enacted after the crisis have been doing in the retail credit market. Okay? So one such policy are interest rate caps. Okay? These are the interest rate caps are essentially price ceilings in the credit market. And they are widespread. More than 80 countries have them in place nowadays. And interestingly, there's several ongoing discussions about whether to implement them or to remove them, which indeed reflects some disagreement on their, on the extent of their efficiency. Okay. Interestingly, despite there being a lot of discussion in terms of implementing them or not, there's very limited discussion about their design, and most countries implement them in very blunt fashion. In particular, they often use like one or two caps for the whole credit market, which seems quite coarse. Okay? So when thinking about this policy in economic terms, the key trade-off is one between consumer protection and credit access. So on the one hand, we could think, look, banks have some market power, or for some reason they're being able to price too high. Well, a cap may be able to protect borrowers from the exercise of such market power. But then on the flip side, if the cap is too aggressive, then it may decrease credit access, right? In the as we're usually taught, kind of in Econ 101, with any price cap, and that may induce consumers either to be left without access to credit or to be displaced towards inferior substitutes. Okay. So what we do in this paper is to study interest rate regulation in Chile, and we look at Chile because of two reasons. One is there's a fantastic policy variation coming from this 2013 reform, which decreased caps for a part of the market, which I'm going to describe, by around 20 percentage points. So it's a large reform that gives variation both over time and also in the cross section. And then there's also fantastic administrative contract level data collected by CMF, which covers the whole funnel of consumer behavior, from the application process to then contracts once approved, and then to repayment afterwards. Okay, so we're going to combine those two in this paper. Okay, and focusing on this setting and using that data, we're going to do three things. We're going to start by just exploiting the policy variation in a difference approach to just tell you descriptively what the market level effects of this policy change were. We're going to be looking at quantities, prices, and risk composition. Okay? And then we're going to look at heterogeneity. We expect indeed risk for risky borrowers to be the ones most affected, and that's what we're going to find. Mm-hmm. Then, of course, that market level analysis is going to be insufficient to say something about welfare, for example, or to study counterfactual policy designs, or what would the effects be under counterfactual competitive environments. Right? So motivated by that, in the second part of the talk, I'm going to show you a simple model that we developed and then estimated for the three stages of the market, that is application, pricing, and repayment. And we're going to use the model to say three things. The first one is going to say something about welfare using a revealed preference approach. So what did these caps do in Chile in terms of improving or decreasing consumer welfare and profits? Then secondly, we're going to try to say something about the role of market power. Would the effects have been different if there was, for example, less competition and therefore more market power and more of a markup to regulate? And then thirdly, we're going to try to allow the regulator to be a bit more sophisticated and match actually how sophisticated banks are in terms of risk pricing, and implement or study a version of caps that are risk-based. Okay, so what happens if we allow the regulator to set different caps to borrowers of different risk, right? Which is essentially cost-based regulation. I'm going to show you the results from that too. Then thirdly, and to complement the revealed preferences welfare analysis, what I did was to collect survey data and ask people about how access to bank credit affects their livelihoods. So in particular, how it affects them in terms of consumption smoothing and in terms of financial distress. And I'm going to provide you some model-free evidence that is consistent with the welfare results that I get out of the model. Okay. So before jumping into the paper, let me just tell you a bit about the main findings. So from the first part of the paper, we find that the reform had sizable effects on the market. Okay, so the number of loans decreased by almost a fifth, and that was partly driven by a decrease in the number of applications. Okay, so people realize that the market is worse now, and therefore starts applying less for loans. Okay, but the headline number is that on the number of loans, which is quite large. So that 19% is for the segment of the market that was directly treated, of course, relative to the segment of the market that was not treated, right? Then interest rates also decreased by 9%. That's as expected. So if the policy is binding, there is going to be some decrease in the average interest rate. And then finally, the effects are concentrated among risky borrowers, and default rates overall decreased by 18%. Okay, so the market as a whole is more stable and less risky. I mean, of course, a lot of that is coming from selection, not necessarily through improved repayment from the pre-existing population of borrowers. Then using the model, we're also going to be able to say three things. The first one is that on average, consumer surplus decreases after this policy, but there's a combination of winners and losers. There's like 20% of winners and 80% of losers. I'm going to talk more about that later. Importantly, welfare losses are smaller in more concentrated markets, which is consistent with the intuition that when the industry has more market power, it is charging higher markups at baseline, and therefore a cap is less likely to harm access and more likely to protect consumers. And then finally, we implement a simple version of risk-based regulation, and we find that indeed it limits the adverse effects of this policy and recovers around a fourth of the welfare loss. Okay. Finally, from the survey, we find essentially two things. And this is all self-reported, but it's quite intuitive. So when a household is hit by a shock and they access bank credit, they do better than households that were hit by a shock and did not access bank credit in terms of consumption smoothing after the shock and in terms of not falling into financial distress. Okay, both of which are consistent with our result that there's on average a decrease in consumer surplus when access is restricted by this policy. Okay. So just a brief mention of the three relevant literatures to which we see the paper contributing. One is just directly regulation of consumer credit markets. There's a bunch of recent work on this area, most of it in the US, some of it related to the Card Act. There's also some about the Chilean policy, including work by Carlos at the central bank. And then to this literature, what we add is first a conceptual framework for this trade-off between consumer protection and credit access, which we think allows for thinking about this policy outside this particular setting and to conduct counterfactuals. And then the data, which is really fantastic, and using them all for updating welfare effects. Okay, so that's contribution relative to this literature. Then the second part is more the IO side of the paper, which is to think of pricing and competition in credit markets, the interaction between those two. Okay, and there's also a strong recent literature on this, and how we see this paper contributing to this literature is by focusing on the interaction between market power and a particular form of regulation, which is price regulation. Okay, and then finally, there is a literature that is more on the finance side, that is about what are the effects of access to expensive credit. Okay? And this is a literature that is very much built of case studies of payday loans in the US. And there is quite a bit of disagreement still, right? Some people, like for example, the Morse paper finds that actually access to payday loans, even if super expensive, actually helps households to cope with shocks, while some of these other papers find that the opposite is the case. Okay, none of these papers do welfare. They just do, so they try to use some observable measures that are like theoretically linked to welfare. We do welfare, and then we also focus on a very different segment of the market, which is consumer loans rather than payday loans. Okay. So the rest of the talk is going to follow the following structure, by which we're going to start by the background. I'm going to give you some details about the institutional environment and data over which we're going to be working. Then I'm going to show you this analysis of market level effects. I'm going to show the model very briefly. Then I'm going to show you how I take the data, what I get out of it in terms of welfare effects, and finally we're going to talk about counterfactuals. Okay, so maybe it's a good point to stop and take any general questions at this point.
Hi, Ignacio, this is Federico.
Yeah.
Else? So one kind of big picture question about the model. Is it going to be important where the market power is coming from? Like, what's the micro foundation for the market power? Is it going to be for because of imperfect information, or just oligopolistic competition between banks, or a combination, or maybe it doesn't matter in terms of thinking about the optimal policy in these type of markets? I don't know what your thoughts are on that.
Yeah, that's a good question. I mean, we are going to be modeling the market power in a particular way, which is going to be as coming from cost heterogeneity, which is in turn going to be driven by say differences in bank efficiencies, differences in relationships, and then some idiosyncratic component. I'm going to give you more details on that. I think the relationship component could capture some relationship to the information channel that you mentioned, but we're going to actually be quite agnostic. We're essentially going to try to use the model to recover cost, and then we're going to call everything between cost and prices essentially market power, right? What we're going to be essentially restricting is banks being differentiated on the demand side. So we're going to be assuming that loans, and in particular loans from different banks, are going to be considered homogeneous goods by borrowers. Okay, and that's an assumption that sort of departs from some previous work, but that we actually find quite sensible, and I'm going to try to motivate it a bit later in the talk. But that's a good question. Thank you.
Yeah, thanks.
Any other questions? Okay, let's push forward. So the Chilean consumer credit market, and I think in the room there's probably people that is more familiar with it, but I'm going to try to give an overview anyways. So we're going to be looking at unsecured consumer loans. During my sample period, which is 2013 to 2015, there's a bit more than 1 million contracts in this segment of the market per year, adding up to more than $7 billion in credit. And these are fairly simple contracts. So you can essentially characterize them with the amount, term, and interest rate. Okay, and that's how we're going to be thinking of them. Then if you think of the relevance of this market, of this segment of the market for households, I would say it's quite relevant. So 15% of, and this is data coming from the EFH, 15% of households in the country hold consumer loans. Conditional on having one, they allocate around 1/5 of their income to repayment. So that's quite important in terms of the household budget. And if we move to the issues of market structure, the market is quite concentrated. There's 15 national banks, Most of them are present in most local markets. If we use a generous measure of what a local market is, the top 3 by this time had around 56% market share. The top 9 had around 98% market share. So if we think of the cross-section of countries, this is certainly much more concentrated, at least on paper, than the US, for example, which has many, right? More banks in local markets. And it's actually quite much closer to what we see in Canada or the UK, where they also have these, competitive concerns about the big 5 and big 6, respectively. Okay, so we should be thinking about those markets as benchmarks. And then there's also, of course, other sources of credit. There's, of course, credit cards and credit lines. We're going to be thinking of those as smaller amounts and often used for more like transactional purposes relative to consumer loans. In fact, if you look at the borrowing balance on credit cards and lines together at the individual level, they add up to around 20% of the average loan in our sample period. Then, in the US, people is always concerned about payday loans as an outside option. They were not available in the market in this period. And then there's, of course, informal lending. And in Chile, we have seen a couple recent worrisome news about the development of the informal market. During this period, according to the EFH, this was a fairly small segment, which added up to around, so the share of households holding some debt on this segment was around 7%. And it was not necessarily, debt contracted with loan sharks, because it also, in the way the questions are asked, it includes family and friends, etc.
Ignacio?
Yes.
This is Ernesto Pasen. One quick question is about mortgages. Do you have also data on mortgages of these people?
We have it. The CMF for sure have it. We thought about it, but the thing is that the mortgage rates are so much smaller, and the cap was not really binding for them.
That's exactly the question, because you may envision someone foreseeing that they would have some trouble to borrow on the customer credit market, and then would like to choose a higher mortgage when it has the chance to avoid, basically to relax the overall borrowing constraint.
Yeah, that's a good point. Yes, so the policy is useful in terms of the variation it provides. The threat, if you want to think of a kind of identification of the diff and diff design, is indeed substitution, right? Substitution either to loans of different sizes or to other segments of the market. In the paper, we try to deal with that. We have some kind of robustness exercises that sort of suggest that there was limited substitution to other segments, but we can't really rule out substitution that much. In particular, we look like within consumer loans, and I'm going to get to this in a few slides. There could be substitution towards larger loans for which the cap didn't change, and we don't see a lot of evidence of that even. And part of that is because the cap for those loans was already lower. So if anything, I'll get to this in detail, but if anything, you would expect people to substitute towards the newly treated loans, but the newly treated loans actually have a higher cap in general. I'm going to get to this in a few slides. Okay. So what the regulation did? Well, here what I have is in the x-axis, I'm going to have time, right? So it's time between 2013 and the end of 2015. And before the policy change, which occurred in December 2013, there were essentially two caps. One cap was for loans under $8,000, and it was at a level of around 55 percentage points. And then the other cap was around 25 percentage points and was for loans over $8,000. Okay, so at this point, Congress essentially discussed, the price of credit is too high. I'm going to show you some quotes immediately. And then what they did was to decrease the interest rate cap for loans under $8,000 in a staggered fashion over the 2 years after that date. Okay, so by the end of 2015, the cap for loans under $2,000 was around 17 percentage points lower, and that for loans between $2,000 and $8,000 was around 24 percentage points lower. In contrast, the cap for loans over $8,000 remained essentially unchanged. Okay, so the variation you see here is coming from variation in the interbank rate, or the policy itself remained unchanged for that group. Okay, so the variation that the policy is providing us with is essentially a time shock, right? That is like that gives us a comparison of before and after, within this market, and then also a cross-sectional variation between loans under and loans over $8,000. Okay, and that's what we're going to be exploiting in our analysis of the market level effects. Okay. Now, what motivated the policy change? And these are names I guess many of you are familiar with. First, of course, there was the concern about prices being too high. So here we have this quote of Senator Tuma saying, look, households are highly indebted and they're paying, usurious interest rates. Then, of course, we had like a known name for many of you saying, if we are too aggressive in setting the cap, we may get exclusion out of it, which is undesirable. Then we have a Chicago-trained economist talking about if there is competition and good information, there's no need for usury loss. That's, I think, like a correct statement, although it's like a sort of a big if, right? And then there's this amazing report by BBVA saying if there is insufficient competition, and this is public, price regulation is going to limit the rents that banks can extract from borrowers in need of credit or unable to switch banks. Okay, so what are the topics here? Are essentially prices are high, right? There is a lack of competition, and then there is a potential for exclusion. And in that line, we do see the trade-off between consumer protection from market power and the threat of decreasing credit access indeed present in this in the discussion that led to the policy that I just showed you. Okay, so that's okay. And let me just show you a bit of the data. So as I mentioned before, this was a project that was developed in partnership with the CMF. We were able to access many data sets, and we essentially constructed 3 main data sets for the analysis. So the first one is just a data set collecting every loan contract signed between 2013 and 2015. For each contract, we're able to observe contract and borrower covariates, as well as subsequent repayment outcomes. Then secondly, we are able to go one step further and say, okay, but what are, of course, some people is rejected here. Can we look at who applied for these loans? And the answer is yes. We have like a large sample of applications, and essentially we see if the application is rejected, well, we see it was rejected, but we still see what the amount and term was for which the borrower applied. And then if approved, we're able to link that application to a contract in this first data set. Then thirdly, there is we say, look, but who is the pool of potential borrowers? It's essentially everyone in the market that has at least a checking account. That's our definition, right? And that's going to be a large share of the population, actually. Okay, so what the bank has, what the CMF has, is essentially a record of everyone that is part of the market. We use that universe of people, and we essentially paste, right? So we merge, right? All their credit history, right? And that credit history is the same data that every month CMF provides banks with for the objective of risk assessment. Okay, so we have access to essentially a very similar data set to what banks use for evaluating risk. Okay, using the data, which is essentially all your previous loans with all the previous banks that you have dealt, and also your repayment behavior, we plus a vector of the consumer level observables, we are able to estimate risk scores. Okay, so we know that in Chile there's no widespread risk scores such as FICO, for example, but with these we essentially build our own FICO scores with data that is very close to what banks actually use. Okay, and then finally we have this fourth data set that is a survey that I collected with JPAL from 1,000 borrowers that essentially collects information about consumer shopping behavior. How many banks do they search? how many quotes they get, what do they look for, etc., as well as effects of credit access. So the first motivates the model. The second one gives us some model-free evidence of what credit does on households. Okay.
Ignacio, just one curiosity regarding the covariates. So what kind of observables you have from the borrowers?
Yes. So for each borrower, we have age. Okay. So location, county. We have age, gender, income. I think that's it pretty much. And then from the credit history, we have so of course we have all your history debt in consumer debt, mortgage debt, and also within consumer debt we can cut between consumer loans, credit cards, and credit lines. And for each, we have that for each bank with which you have dealt, and then for each loan we have repayment. So we can compute, for example, leverage, levels of indebtedness, etc.
I see. Thanks. And when you say risk, what you are computing is probability of default.
Exactly. Yeah. It's a 90-day default as an outcome, and then we essentially estimate, a reach kind of statistical model of default.
Okay. Thanks.
Okay. So a few summary stats, just so you get familiar with the data and the context. So in terms of the contracts, we should be thinking of the average contract here as one with an interest rate of 23 percentage points. That's an APR for an amount of around $7,000 and for a maturity of 3 years. Okay. Now there's a lot of variation in these terms over time. I'm going to show you some price histograms in a while, and you're going to be able to appreciate that. Then in terms of default, the likelihood that a given loan ever defaults on one payment is around 11%. Okay, so default is not, so it is higher than in other contexts, but it's not too high relative to, for example, the interest rate. I'm going to also show you charge-off rates in the next slide. Now, in terms of consumers, we're going to have that the average monthly income is around $1,500 again. So, I mean, this is not like incredibly high, but it's certainly not, we're not like really talking about the poor households here. We're actually talking about an upper segment of the population, and there's going to be a lot of variation in income across households in the sample. And then this is a known fact, stated like many times in reports from the bank and also from CMF, that Chile has levels of indebtedness that are quite high. In fact, in our data, the average ratio of consumer debt in a given month, so that's the total debt portfolio from consumer debt over monthly income is around 4.5, which is quite high relative to other countries. So this product indeed has a high penetration in the market. Okay, now trying to show you start with a bit more meaning, right, and trying also to motivate them all. What I wanted to show you is how much heterogeneity there is, right, and this is going to motivate then our heterogeneity analysis for the effects of the policy. So in the x-axis, we're going to have 5 quintiles of a borrower risk, right? So on the left-hand side we have the least, so the safest borrowers, and then on the right-hand side we have the riskiest borrowers. And for now, I'm just plotting 2 measures of risk realizations, in particular the default rate. That's the share of loans that ever default on a payment, and then in black it's the charge-off rate. That's the share of the loan amount that is written off. Okay, both are increasing on risk. I mean, they better, right? Otherwise, our risk scores would not be very predictive. But then actually the slopes are quite high, right? If we move from the first to the 5th quintile, the share of loans falling into default grows by a factor of 5. The share of and the charge-off rate grows by a factor of 10. Right? Now, how do banks set prices on these different borrowers? And of course, we know there is quite a bit of risk pricing in this market. So now I'm overlaying the average annual interest rate on loans for each quintile of risk. And they are indeed increasing. In fact, if you move from the 1st to the 5th quintile, the average rate almost doubles. Okay, so where should we expect to see the most effects from this policy, if any? Well, we know the policy is essentially flat, right? It's unrelated to risk. So there is going to be quite a bit more room here to set a cap than here. And indeed, we should expect, and that's what we're going to find, that most of the effects are concentrated on the upper tail of borrower risk. Okay. So any questions you may have? Okay, let me move forward. So we get to market level effects. The goal here is quite simple. It's essentially to measure effects and equilibrium market outcomes. The outcomes of interest are going to be prices, measures of quantities, such as the number of loans and applications, and then risk composition. And the idea is to use these results to then motivate the modeling choices, right? So the design is to exploit variation before and after the policy, and then across these two groups. The treatment group are loans under $8,000. The control or comparison group are loans between $8,000 and $20,000. Okay, and the threat of substitution that you asked about before is indeed there, right? So we have that now a segment of the market is being set a lower cap. So that segment of the market is becoming more attractive relative to the rest of the market, right? Because prices are now supposedly lower there. Okay, but the sort of the baseline variation in caps helps us in a way, because as I showed you in the plot of the regulation, the cap for loans that in the comparison group is throughout the period actually lower, right? So that should limit the extent to which borrowers want to substitute towards the treatment group where they are likely to get a higher loan. Okay. Then, so we studied the distribution, and this may be related to that question too, the distribution of application amount and term over time, and we really see no difference in it. So it does not seem that the consumers are being strategic in terms of adjusting the contract that they're demanding in the market. And then finally, to sort of try to address this, it doesn't really kill the concern, but it helps. We look at alternative comparison groups. So, and in particular, the exercise that I like the most is that we open at what is called the donut hole around the cutoff, where most of the substitution should occur. Like you may want to adjust your loan amount slightly, right? So we open a donut hole of different sizes and compare like markets that are further away but still treated and untreated, and the result is quantitatively essentially the same. Okay, happy to show those results if they're useful.
Ignacio, just another curiosity. Have you tried analysis, but like separating the control group and the treatment group in credits that are just above or just below the cutoff? Oh, does that make sense, or it's not relevant?
Okay, so I mean that's so yeah, you're thinking like more like of an RD design.
Something like that, yes.
Yeah, I mean, I did at some point, and there's not like it really seems like most of the effect is like a level shift in the segment as a whole, rather than an effect right at the margin. And then if we're worried about substitution, my concern would be that indeed the substitution should be focused right around the cutoff, which is, I mean, kind of is not an advantage when thinking of an RD design. But yeah, I agree that it would have been an alternative.
Thanks.
Okay, so let me show you what happened with prices, and then I'm going to go to the different results. Okay, so this is a histogram of prices before the policy change. So this is in November 2013. You can see that there's quite a bit of dispersion. There's some people getting rates, in the 10%, and then some people getting rates in the 45%. Okay, lots of dispersion. Some of it is likely driven by risk, right? So that some of it is just cost heterogeneity. Some of it might be just market power, right? Okay. What happens when we impose the cap that was set by the end of the period in November 2015? Okay, so it decreased from essentially 55% to around 37%. Okay, and we can ask, what's the share of loans that was exposed, which is this mass over here? Oh, that's 42%. Okay, so then here we have essentially a test for imperfect competition, right? If these loans were offered at a competitive price, then there would be no way for banks to offer these loans at this cap over here, right? Therefore, if we see bunching at the cap, we can interpret that as suggestive of imperfect competition. Okay, that's indeed what we see. So now I'm adding in these white bars what the histogram of what the density of interest rate was right after the end of the implementation of the policy. And we indeed see that a lot of this mass moves down, right? So banks decrease the price on them and bench right below the cutoff. Okay, and we're going to interpret that as evidence of imperfect competition. And when thinking actually of identification of the model, this is an important moment to think about it. Okay. Then, in contrast, if we look at the comparison group, so loans between $8,000 and $20,000, the distribution for them is going to be essentially unchanged. Okay, so there's a bit of movement over here, but that's essentially because of how the data is tabulated. But the distribution overall remains essentially unchanged, which is consistent with the cap only, slightly decreasing. Okay, so now we move to the market level analysis. Indeed, we're going to be estimating a difference in difference model, where the outcome is going to be some aggregate measure at some level of aggregation that is going to be given by bins of loan amount and term. Okay, so think of it as, for example, of this outcome Y as the number of loans between $0 and $1,000, and for a term of between 0 and 12 months. Okay, there's going to be one bin, and then we're going to have several such bins. Okay, and some of those bins are going to be treated, those with a loan amount under $1,000, and then some other bins are not going to be treated. Okay, we're going to also be splitting the sample in two risk bins, so high and low risk, as defined using the pre-policy distribution of borrower risk. And then we're going to also be looking at month as the frequency of time. Okay. On the right-hand side, we're going to have a vector of damage indicating treated loans and months around the policy change. Okay. And what I'm essentially doing is to estimate a dynamic diff leaf, so I can show you the pre-trends leading to the policy change. Okay. And then there's going to be a vector of coefficients, which are these betas, which are going to be the coefficients of interest. And those are measuring the effect of the policy for borrowers of type R, which is high or low risk, exactly 10 months after or before the policy change in D0. Okay, we're going to add market and month fixed effects interacted with the borrower risk. Okay, let me show you the results. The results are, so I'm going to show you a sequence of these plots, where in each of them, I'm going to have time around the policy change in the x-axis. So the policy change is here at 0. We're going to have almost a year before it and almost 2 years after it. Okay, and then for each result, I'm going to show you separately results for low-risk borrowers and for high-risk borrowers in blue and red, respectively. So and then on the y-axis, we're going to be measuring the effect on a given dependent variable. Okay, so we're going to start by looking at average interest rates. And what we see is that indeed the pre-trend leading to the event tells us that the two segments of the market were evolving in parallel fashion as desired for a different design. And then after the cap starts decreasing, rates as well start decreasing, slightly over time. And they only really decrease when the cap is like low enough, right? And why are the effects so small here? So we're talking about like either 1.5 or maybe like 4 percentage points for both groups. Well, this is the average rate, right? We're going to look now at what happens at the upper tail of the distribution, and effects are going to be much larger. Now, what I want you to note here is the difference between the two groups, right? So most of the effect is concentrated among risky borrowers, which were more exposed because of the utilization of risk pricing by banks in this setting. So what happens when we look at the effect on the 90th percentile of the distribution of interest rate? Well, the effect is much larger now. And if you look, for example, at what happens with high-risk borrowers, then the effect is around 8 percentage points, okay, which is quite large already. Now we can look at quantities. So this is the effect on the number of loans. And then again, we see decreases for both groups once the policy is fully in place, but the decrease is certainly much stronger for risky borrowers. In particular, these coefficients over here suggest that the number of loans for risky borrowers decreased by around 30%, okay, which is sizable, right? And then part of that is going to come from a decrease in applications, okay? So what we see here is that after the policy was implemented, risky borrowers decreased their applications by around 10%, okay? So what this is telling us is that borrowers seem to understand that with a stronger cap, the market becomes tougher for them, and in particular, their approval probability decreases. Okay, so they are aware of the sort of the credit access effect of price regulation, which sort of compensates for any consumer protection effect that the policy may have. Okay. Now, because all the effects are concentrated among risky borrowers, and in particular the quantity effects, right? We do see that the average borrower risk score in the market decreases. That is, the pool of borrowers that remain in the market is safer than before. And that's going to be consistent with the decrease in default rates that we measure. Okay. And finally, to link to the motivation of a market power and profitability of banks, here we estimate effects on expected markups. Okay. And in particular, we think of expected markups as the difference between price and expected cost. Right? I already showed you there was a price effect that was negative. I also showed you that there was a cost effect in that the composition is getting better. Overall, expected markups decrease, which suggests that the price effect is stronger than the cost effect. Okay, so if part of the goal of this policy was to, decrease profitability by reducing prices, that seemed to be indeed happening, albeit at the cost of some exclusion, which we showed in the previous plots. Okay, so let me summarize and then take questions in case there's any. So what we're finding so far is just a bunch of facts, right? First, the policy was binding. We see that from the price histograms and the price diff results. Average interest rates decreased by 9%. Interest rates in the upper part of the distribution decreased by much more. The number of loans decreased by almost a fifth, and that was partly driven by a decrease in the number of applications by borrowers. And then there's an overall shift towards a safer borrower pool. Okay, which indeed reflects in a decrease in default rates of as much as 18%. Okay, so overall, the market looks safer, but that's a lot of it is coming from selection, right? Just a selection of better borrowers. We can add, using these numbers, we can just like add up at the market level and say what these effects imply, and they indeed reflect the trade-off of interest. So in terms of consumer protection, the price effects imply that monthly payments decrease by around $3 per month on average, which add up to $32 million less in monthly payments for consumers in the market. Okay, and then if you think of credit access, well, the number of loans decreases by around 150,000 per year, which adds up to $360 million in loans per year. Of course, these two numbers are not comparable, but the point is that the trade-off that we are interested on does indeed appear to be already visible in this diff analysis. Okay, so let me take questions about this analysis here, in case there's any.
Yes, Ignacio, there is a question from the audience. Joaquin, we're gonna open the microphone for you.
Yeah, it's just for the results in flex of applications. If you have any anecdotal evidence or anything that you can distinguish between clients that don't want to applicate in this case, or it's that banks don't put any effort to look for these clients, especially for the risky ones.
Okay, that's a good point. Yes, I mean that's often a limitation with data sets that collect information on applications. You don't really know what is like at what stage is an application recorded. So it's like really hard to tell, right? I think there's like two relevant caveats or stories. I think yours is more about, there could be a decrease in recruitment, like in customer recruitment efforts by banks. You could see that, for example, maybe looking at the advertising data. Like I've been trying to get advertising data by banks and seeing whether, for example, it fell, and if it fell particularly strongly in, say, lower income neighborhoods. That would be suggestive of your channel. And then there's a second one. That is maybe everything. So the recruitment effort remains the same, but then when a customer shows up at the bank, the loan officer looks at him and tells him, "Look, there's no way I'm giving you a loan. I'm not even going to let you apply, right?" And then we can't really disentangle those three, right? Is it that applications decreased from the demand side? Is it that recruitment effort decreased and that made applications decrease? Or is it that the demand side isn't changed and then officers actually just stopped recording some applications so they don't show up in the data? And that is a limitation of the result. I agree. I mean, we would love to have more evidence on that. And I think the advertising avenue is sort of promising, but I have had trouble getting the data. So if there's any suggestions there, I'm happy to take them.
Thank you very much.
Okay, so let me try to link these to what's coming next in the talk. So,
Ignacio, there is another question, sorry. Yeah, Benjamin, go ahead, please.
Hi, do you hear me?
yes.
Yeah, I just want to ask if you see something on the average amount of the loans, especially on the cutoff. What I mean is that maybe the thing that people can actually get the loan at a different rate is not only because of imperfect competition, but just that they now require that they post more higher collateral, or lower bond size for the same collateral. And I don't know if that's happening, but that could explain like the bunching on the cutoff without being for imperfect competition. I mean, obviously there's a lot of imperfect competition, but not accounting for the size of the loan, maybe it's not complete proof of that hypothesis.
Okay, so yeah, that's a good point. I think it also relates to the questions about the substitution from earlier. So two things. One, as I said before, I don't think we can really discard the threat of substitution. So we do our best to try to show the design is robust to alternative comparison groups. To your particular point, what we do is to look at the distribution of loan amount requested. So that's at the application stage, like from the demand side, we look at whether there's a change over time in the average and percentiles of the distribution of loan amount that people apply for, and we don't see a lot of action there. Okay, so that sort of suggests that there doesn't appear to be much substitution there. Now, I mean, to the collateral point, actually these loans are unsecured, right? So there's no collateral involved in them, and that's sort of a relief in that sense.
Okay, thank you.
I don't know if that helps.
Yeah.
Okay. Any other questions? Yeah.
Yeah, I have Ernesto Pastel again. So could you please go back one slide? So about bullet 3, I just want to ask some clarification to get this right. So the decrease in the delinquency, if you control by the interest rate that of these loans before and after the policy, right before the cap, right below the cap, sorry, there is also a decrease in delinquency?
Just below the cap?
Yeah, so you showed...
Yeah, I guess I'm trying to disentangle selection from moral hazard.
Right.
Yeah, that's a good point. So in the paper, actually, we're really agnostic, or we don't address the issue of moral hazard. And you're going to see that in the model, we actually assume it away. Yeah, I mean, I thought of ways of addressing that. That's a good. Yeah, sorry. I don't really have a good answer for that. I should have one.
Okay, so it's overall delinquency, the one that decreases once some guy gets excluded. It's not some way to construct the counterfactual of what is the rate of delinquency of those guys who otherwise would get a higher interest rate than the cap, but now get an interest rate below the cap.
I mean, I agree that the two effects are okay. So if I understand well, I agree that the two effects are conflated. So because a lot of people was getting a higher rate and now it's getting a lower rate, but they're like the same individual, right? Those guys, if anything, are improving the repayment through a moral hazard channel. But then I also showed you how the overall risk score of the market improved a lot. And I hopefully convince you that there's a lot of risk selection going on around the policy. So I'm sure part of this is also coming from just selection. But I agree. I mean, probably both of them contribute to some extent. And
okay.
Yeah, I don't have Yeah, but I agree that it would be nice to think of ways to disentangle the two in a clean way. That's a great comment. Thank you. Okay, so three kind of limitations of this analysis that motivate the remaining of the talk. First, the analysis is silent about welfare, right? And I would like to know whether this increases or decreases welfare, and that's going to depend on which side of the trade-off dominates at the individual level. And we would like to have a distribution of effects on consumer welfare. But for that, we actually need two ingredients, right? We need the willingness to pay and also cost, right? And for that, and we can't get that out of this different analysis. Then secondly, we would like to know, would the effects be stronger if there was more market power? But it's hard to actually implement that on observational data, for example, by comparing markets in the cross-section, say markets with high and low concentration, because we know market structure and concentration are endogenous, right? And they're like driven by difference across markets. So we need to somewhat control for the endogeneity of market structure, and we can account for that in the context of a model. And then thirdly, we would like to think of more sophisticated regulation. But if that is going to change, for example, application and pricing incentives on the demand and supply side, then we can't actually implement that counterfactual in the context of this different diff. Okay, so these three limitations of the different diff, and also like the goal of having like richer results, motivate the model that we're going to be writing down, which is actually going to be fairly simple, very stylized, and riddled with assumptions. But I think it is like a good characterization of how the market works, and I think it is able to deliver some interesting insights. Okay, so let's go to that, and please feel free to stop me at any point. You don't have to wait for my process. Okay, so the model is going to have three stages. We're going to start with a pool, and this is going to be a static model, and so we're going to be thinking of a cross-sectional model. We're going to have a pool of potential applicants, which are going to be endowed with a vector with the 5 elements. X over here is going to be public information. So think of that as this data that the regulator gives to banks every month. Then there's going to be an application shock that is private information on the held by the applicant on their value of the loan. Then there's going to be L and T, which are loan amount and term, and we're going to be thinking of them as exogenous, partly motivated by this lack of response to the policy. So essentially, people have a shock, and then they try to get a loan, related to the size of the shock to finance the shock. And then there's going to be Z, which is an application cost shifter. Okay, so the model, and then if you want to begin thinking about identification, is going to be essentially a selection model, and we're going to need some shifters of cost in the selection equation to identify the model. Okay, I'm going to tell you to specify everything in the next few slides. Okay, so in the first stage, these potential applicants, they receive a shock and they choose whether or not to apply. If they don't apply, they're like out of the market. If they apply, they go to the market. Right? The way we're going to be thinking about the interaction between borrowers and consumers is going to be as follows. Right? So let's line up all the banks in a street. Like think, for example, like as a fair, right? And then consumers are going to be walking from bank to bank, gathering offers and trying to get the best outcome. Okay, so it's quite intuitive. It's a bit demanding on the consumer side, but it's quite intuitive. So you go to this has been very well documented in the context of mortgages, for example, less so in the context of consumer loans. But then in the survey, I do some effort in terms of showing that the consumers do shop often for multiple banks. Okay, and where multiple does not need to be like the whole market, but maybe like 2, 3, 4, 5. Okay, so the consumer is going to go to a bank, get a quote, then go with that quote to the next bank, and then so forth until there's only one bank that is remaining in the market that is willing to serve the borrower. Okay, that bank, so the price that bank is going to be able to offer is going to be such that the second, the runner-up bank is actually indifferent between offering the loan or not offering it. Okay, and that's going to be essentially the logic that is of how prices are going to be pinned down in the market. Okay, so banks are going to be heterogeneous, and this speaks to Federico's question at the beginning. They're going to be heterogeneous in their cost. Okay, and there I'm going to specify cost as well, and it's going to be intuitive. For now, we're going to call this cost omega, and omega is going to be essentially a cost shock. So different banks are going to have different costs of serving every borrower, and those are going to rule to determine, you know, who approves, who rejects, and at which price do approvals score. Okay, the outcome of this stage is going to be either a rejection, and that happens when you go to the market and no bank is willing to serve you, which in the data happens, right? Or an approval, which is when some bank is actually willing to approve it. And then if they approve you, you can get an unconstrained approval, which is an approval at a price below the cap, or a constrained approval, which is an approval at the cap. Okay. Then once you're approved, repayment is realized. There's observables in repayment, of course, but there's an additional shock here that is also private information of the consumer, which we're going to call epsilon S. Okay, and we're going to allow for epsilon A, the application shock, and epsilon S, the repayment shock, to be potentially correlated. Right. So we're going to be allowing for adverse selection or advantageous selection, but you know, we think more of adverse selection in this context in the model, and we're going to estimate the extent of such selection. Okay, so what I'm going to do now is to go from the last stage to the first stage, giving you some more details about each of them. I'm going to start with the repayment stage. We're going to think of repayment in a very simple fashion. We're going to be thinking about it as sort of like a statistical model of repayment. We're going to like relate whatever repayment we observe to observables X and loan term and amount T and L, and the repayment shock epsilon S. Okay. In particular, we're going to specify it right away, so you see how I estimate the model as a simple exponential function that is between 0 and 1. Okay. So what this little s is the share of the loan that is eventually repaid. Okay. And then total repayment is going to be, well, the repayment length, that is essentially the share times the overall loan term. Okay. And back to the previous question, you can see that here I'm essentially ruling out moral hazard by not including price in this repayment function. Okay, and it is an extension of the model that we could engage in. It's going to be a bit challenging, and it's going to complicate things a bit, because when the firm is pricing in the second period, the firm is going to have to keep track of the fact that by moving prices when signing the contract, that's going to affect the repayment in a later stage of the game. Okay, so we simplified by just ruling it out for now, and then we support that with the fact that there's a really mixed evidence on the existence of moral hazard in this market. Okay, but we agree it's a limitation of the framework. Then we move back to the second stage of the model, and essentially the description I gave you before is the same as an English auction, right? You're running an auction among banks where you start at a very you start from a very high price, and you start falling, and then you stop where only one bank remains, in the auction, right? If you want to relate it to usual models of competition, that's essentially equivalent to a Bertrand model with homogeneous goods, because all contracts are valued the same by the consumer, and heterogeneous cost. Okay, and essentially it's going to be borrowers bargaining on prices until the second lowest cost bank makes zero profits. Okay, so the motivation for this is, I guess, twofold, right? One is, we're trying to make the model realistic and capture the fact that there's some bargaining on prices in these in credit markets, and in contract markets more generally, relative, for example, to a posted prices model. Right? That's the distinction we're trying to capture. And then, from an empirical point of view, an issue with contract markets is that you only see in the data contracts that are signed, right? So if you think of, you're considering 10 banks, right? And then in the data, I'm only going to be able to see the contract, the particular contract that you sign, and therefore I see one price out of 10 prices that you considered, right? So one approach that has been actually recently used in a paper by Crawford and others that was just published in the AR is to maybe predict prices. Say, look, I have really good data. I'm going to predict prices for the other J-1 banks. But then an implication of that is that most of your price data is essentially imputed, right? And there's issues with the private information because you don't have it when predicting, right? And that's a limitation. But then, like on top of that, when you predict, you are assuming that the market is indeed of posted prices, and we want to argue that actually there is quite a bit of negotiation in credit markets. Okay, so that's the motivation for this assumption. Let me show you how we actually write things down for firms and how prices are pinned down. So profits are going to be, so firm profit, the firm doesn't observe the epsilons, therefore it has to take an expectation over them. Expected profits are going to be the difference between two streams of payoffs. Right? One is a stream of payments, which is risky because consumers may or may not repay. Right? And here the firm is taking the expectation over epsilon s and conditioning on the application choice. Right? So if the firm knows the joint distribution of the consumer receivables, then the application choice is going to tell the firm something about the risk, the repayment risk of the borrower, as usual in models of other selection. Then costs are actually certain, right? Why? Because the firm knows that it has to fund the loan over time, and then any additional cost that the loan involves for the bank are going to be have to be paid anyways. Okay, so we have an uncertain stream of payments and a certain stream of payoffs and costs. Sorry, and the difference between those two are going to be expected profits. Okay, so let me dive a bit into costs. What are going to be the components of cost? Well, F over here is going to be the funding rate. We're going to assume that the funding rate is essentially the same for all banks. And then omega is going to be this bank borrower level heterogeneity. I'm going to specify it as, by focusing on three components. The first one is going to be this, tau j's, which is going to be a mean shift in bank cost at the bank level, right? So that's going to be like saying, look, different banks may be differently efficient, and that's going to be to imply that they have different costs, and then that's going to reflect into different market shares. Then secondly, there's going to be relationships. If one has a previous relationship with the bank, it's going to be cheaper for the bank to deal with me. Okay, and therefore that's going to we're going to estimate that that's going to actually decrease the cost of originating a loan for that consumer. And then there's going to be a third component that is idiosyncratic. You can think of, your match with a given loan officer, or just, some local differences, some difference in the banks in the local market where the consumer is located. And we're going to impose that additional term follows a type 1 extreme value distribution. That's just for, a convenience in terms of the tractability of the model. Okay. Now, what's going to be bank behavior? Well, banks are going to approve if, so they're going to essentially remain in the market as long as the expected profits are positive at the current price. Once the current price gets low enough, then banks are going to leave the market and reject the borrower. Okay. Now, how are prices pinned down? Well, in absence of regulation, prices are going to be pinned down by this equation over here, which is going to combine three elements. The first one is just marginal cost. The second one is going to be a markup that is going to come from the cost advantage of the lowest cost bank relative to the second lowest cost bank. And then there's going to be a risk multiplier, right? So this is essentially capturing the extent of risk pricing in the market. Okay. When we add regulation, embodied in a price cap P, there's going to be three potential outcomes. One is an unconstrained approval, which is essentially going back to this equation up here. The second one is a constrained approval at the cap, and the third one is going to be a rejection. Okay. So are there questions here? I mean, I'm actually happy to get your questions or comments at this point.
So this is Federico again. So the markup here is estimated like a residual of this cost for these two banks. Is that correct?
Yes. I mean, what we recover, so we can, using this pricing equation, and actually this like free processing and approval outcome equation, you can invert the distribution of cost. Mm-hmm. So we estimate the distribution of cost, which is going to have the three components I mentioned in the previous slide.
Okay.
But it is, you're right, it is essentially a residual.
Okay, so I guess, I mean, this is kind of going back to a question I asked before. in terms of understanding where the markup. I mean, I know I can see in the model where it comes from, but like in the data, whether there's something in the data that could tell you why are these banks able to charge markups? Is it because, you know, spatial concentration, or I guess you talked about some of these things, but I wonder whether there's something in the data that can inform you a bit more about where this is coming from.
Yeah, no, that's actually a good question. So I agree that the explanation that, you know, markups are coming just from cost heterogeneity may not be fully satisfying, even if we think of those other things that you're mentioning, for example, some spatial stuff or, you know, something like that, as you know, being captured as cost differences, right?
Yeah. No. I agree that this is sort of the strategy to estimate, but then the question is, where are those differences coming from? Yeah.
No, so I mean, I'm going to tell you that actually banks are quite heterogeneous in cost. So there are some banks that are indeed much more efficient than other ones, and then relationships are going to be the key one, right? So if you are previously related with the bank is going to offer you a much lower rate, right? And that's you know, there may be like some informational story over there that's a bit tricky to handle in the context of the model. There may also just be like lower administrative cost in the sense of origination, and then just like you know, keeping track of your stuff. But then just like as I'm, you know, just to like for the sake of discussion, what I'm working on now is in extending the model to add a simple way to capture search, right? So indeed, I think what you're thinking is more like, you know, maybe it is like too demanding on consumers to have them like shop around so much. Maybe they just save less than that, and that gives banks more market power because they're playing the same game but with the smaller choices, right? And that indeed, so I already have like, you know, some results for that, but I haven't been able to really close it up. So when you do that, actually the extent of cost heterogeneity over here becomes a bit smaller, because part of the price dispersion that you're trying to explain, which is essentially the left-hand side in this equation, right, is going to be explained by this, you know, heterogeneity in search intensity across consumers. And I mean, I would have liked to have those results today. I just don't have them yet. Now, if you like, you know, just to keep you tuned for the rest of the talk, most of the results remain essentially unchanged for the rest of the talk. So, you know, qualitatively, there's like no change, and then quantitatively there's some changes, but very slight.
Okay, great, thanks.
Thank you. Okay, then let's go up to the upper layer of the model, which is this application behavior layer. And there we're going to be thinking of consumers applying or not for a loan given this shock that they receive, right? So they need a loan of size L and they want a contract of term T, say that's coming out from some complex optimization problem. And they're going to go to the market and choose and say, look, do I apply or not, right? So the utility from applying is going to come from the combination of the expected value of approval and application cost, and then the application shock epsilon A. The expected value of approval is going to be the probability that you get approved times the expected utility from a contract condition on approval. Okay, so that's essentially the consumer knows what he or she would get from the contract. It doesn't know what price he or she is going to get. Therefore, it integrates over the density of prices condition on approval. Okay. And we're going to, again, specify this in a simple fashion. So essentially as linear on consumer covariates in known terms and prices here. And then application cost is also going to be a linear function of the application cost shifters. Okay, so this is essentially a bit disappointing in terms of understanding kind of consumer dynamics, right? Because we're using here, specifying here a very reduced form utility function. So we're, for example, unable to answer some counterfactuals, but for the sake of the counterfactuals we are interested on, it's actually going to be sufficient. Okay. Finally, we're going to specify a joint distribution for the two shocks. In particular, we're going to say, look, the application and the repayment shock, both of which are private information of the consumer, are going to follow a joint normal distribution where the key parameter is going to be this rho term. Okay, so rho is going to capture the extent of selection and unobservables. In particular, we should be thinking that a negative value of rho is going to give us adverse selection. Okay, so why, right? So think of a consumer that actually has, so think if consumers with very low rhos, so with very low epsilon S's, right? Which are guys that are unobservably very risky because they are very unlikely to repay. are also the consumers that have high epsilon A's, so high values from applying. Okay, then the correlation between those two shocks is going to be negative, and we're going to have that the guys that select more often into the market on unobservables are also the guys that repay less often on unobservables, right? And we're going to get adverse selection. Okay, so
Ignacio, and how do you identify this raw from the data?
Okay, I'm going to get to. Okay, so I mean, I think in terms of time, I'm not sure I'm going to be able to go into that in detail. So I can actually just tell you. So I mean, so the question is about row or about something, or about the whole model?
No, about row.
Okay, no, yeah. So essentially, as usual, these selection models, like think of all the ANAB and Finkelstein stuff, like, work in insurance markets, and also some of it, the ANAB lab in Jenkins stuff on credit markets. What they think of is that, look, if and this all comes from the Chiappori sort of from the work by Pierre-André Chiappori, right? Essentially, if you have enough observables, and in particular, if you feel like you have the same observables like that whoever is pricing in the market is using, then conditional on those observables, the correlation between the observed choices of application and repayment is going to tell you about the correlation between the two shocks, right? And that's going to pin down row. So if conditional on X, which is what I have here, right? And also L and T, which are the loan contract terms, I get a negative correlation between application behavior and repayment behavior, then that is going to be captured in the model by a negative value of row. And that's how row is identified. Make sense?
Okay. Yeah, yes. So it's exactly the correlation of the pair that you can, it's like residuals, these things.
Yes.
Yes. Okay.
Yes. Okay, so going back to the first slide, I'm trying to connect this machinery to the trade-off of interest. Let's think of what the model tells us in terms of effects from price regulation on the demand side and the supply side. So in terms of, for consumers, and thinking of a consumer surplus, if you increase, so if you make price regulation stronger, then the model is telling us that there's going to be two effects. The first one is that the approval probability is going to decrease, right? And therefore credit access is going to decrease. That's a sort of the adverse part of the policy. The flip side is that if you are approved, then you're going to get a better rate, conditional approval, right? And that's a positive part of the policy, which we have labeled consumer protection. Okay, so the overall effect on consumer surplus is actually uncertain, ambiguous, and it's a motivation for taking them all to the data, which is what we do next, right? Then on the supply side, we're going to have three effects. There's two fairly obvious effects on the intensive margin of the market. When you're imposed a cap, you are less likely to approve some loans, so you lose profits from those loans, and then you're also less able to price some loans high. So there's an approval effect and a price effect, and both of them harm profits. Then on the extensive margin, there's an application effect that is ambiguous, right? Essentially, if up here, the consumer protection effect dominates the credit access effect, then the policy may bring people into the market, right? And then firms could benefit essentially from getting profits from those additional guys. Then in the flip side, when credit access dominates consumer protection, the application effect is going to be negative, and is going to be a third way in which firm profits are harmed. Okay. Now, so I think in the interest of time, I'm going to skip the estimation of the model. I'm just going to give you a couple details on the results. I'm happy to stay after the seminar and chat about it in case there's any interest. Okay. But the main results are as follows. In terms of application, some important drivers of application are first, approval probability. So when you perceive that you are more likely to be approved, it's more likely that you will apply. That's fairly, as expected. Then prices decrease applications, right? And they do more so for safe borrowers than for risky borrowers. And then risk scores, which are observed, increase applications as well. Okay, so there is observable selection of riskier borrowers into the market. Okay, then in terms of repayment, the main driver of it is a risk scores as well. So when you are riskier, you repay less. then we do not find evidence of any important degree of adverse selection into the market. Okay, so there is a lot of observable selection because riskier borrowers are more likely to select into the market and to repay less, but not a lot of unobservable selection, which is consistent with the data we have in X actually being quite rich and quite close to what banks have. And then in terms of bank cost, and this may or may not help Federico, essentially what we find that there's a range of bank efficiencies. So banks do price very differently on average, suggesting that which the model rationalizes, right? And I think that's Federico's comment. That they have just different degrees of efficiency. Then relationships matter quite a bit. And if you are previously related, actually the cost of serving you for the bank is much lower. And then there is this remaining idiosyncratic dispersion in bank cost that is of a somewhat smaller magnitude than the other two components of costs. Okay. And then just to show you, I just wanted to show you this. The model is even though the model is quite simple, right? It's just like static, 3 stages, quite limited. It actually fits the data quite well. So if you think of the application share, the share of applicants, the application outcomes, so these are the share of people that is approved and constrained, the share of people that is approved, constrained, and rejected. Then this is the distribution of monthly payments in the model and data, and this over here is the market shares observed in data vis-a-vis the predicted market shares by the model. Okay, and all of them overall, I feel like the model does a fairly good job in terms of fitting these models. Okay, so now let's in the final 6 minutes, let's try to use this model. Okay, and the first thing I wanted to show you was welfare effects. Okay, so I'm not going to show you what happened with market outcomes. That's all in the paper, and it's sort of what we already discussed in the diff analysis. But this should be interesting, right? So what we have here in the x-axis are different counterfactual policies. I can now use the model to move the cap around and see what happens in terms of application, pricing, and then consumer surplus and profits. Okay, so we're going to be looking at outcomes relative to the baseline. So outcomes relative to this level of 54 for November 2013. And bars are going to show you 3 groups. In blue, groups with the share of winners, right? In red, the share of losers, and in gray, the share of unaffected consumers. As you move to the left from here, right, the share of winners and losers is actually quite similar when you consider small decreases in the cap, say from 54 to 45, right? So a moderate decrease actually generates a large share of winners, right? Now, as you move more and more to the left, the share of winners decreases and the share of losers conversely increases, right? And in particular, if we focus here on November 2015, so that's at the level of the cap by the end of the period, the share of losers is around 80% and the share of winners is around 20%. Okay. Now, do the gains of the winners compensate for the losses of the losers? Actually not. We find that on average, expected consumer surplus decreases, right? So the losses of the losers more than compensate for the gains of the winners. And then if we look at the supply side, profits also decrease, coming both from a decrease in the prices they can charge, but also from a decrease in the size of the market overall. So there's those two effects that we mentioned before. Then I think it's useful to stop for a second and think about heterogeneity, like who are these guys? And then what were the kind of the policymakers thinking, right? So a nice thing of the model is that we can actually decompose the pieces involved in this trade-off. Right, so we can think, look, there's a trade-off here between a decrease in approval probability from the policy and a decrease in the expected loan payment. Okay, the former is bad for consumers, the latter is good for consumers. Right? So we can actually plot those for each individual in the sample in this plot over here. Right, so this over here, for example, is people that gets a large decrease in the approval probability and also a large decrease in expected monthly payment. And then the question is, what do politicians think when they implement these policies? And it must be that they're thinking that there's a lot of mass up over here, right? Where people can get large decreases in prices without seeing their approval threatened, right? Well, it turns out there's in this setting, at least, there was limited mass over here, and most of the mass was in the diagonal, which is consistent with the trade-off we are pushing, right? Then a second dimension of heterogeneity that we find interesting is to look at the cross-section of borrower risk, right? So we can compute average and different statistics of the consumer surplus effects for each, the borrower risk type. And what we see is that as we move towards riskier borrowers to the right of that plot, the average effect in consumer surplus becomes more and more negative. Okay, where is that coming from? Well, from three things. I showed you that they had a stronger preference for loans. I showed you that they were less price sensitive, and then I also told you that they are the most exposed. Okay, so that's in terms of welfare analysis. I don't know if there's any questions. Okay, so I'm going to skip the survey stuff, and I'm going to just give you a brief description of what I do in terms of market power. Essentially, I can ask the question using the model, what would happen if instead of having, say, 9 banks as I use for estimation, I had less, right? So that the market was less competitive. Well, the trend we see, and I'm not going to be able to give you all the details because of time, is that as we move towards more and more concentrated markets, the overall effect remains somewhat negative, which is, this blue line being below 0, and that's measuring the change in consumer surplus from the baseline policy change. But it becomes less and less negative, right? Which is telling us that the adverse effect of this policy are smaller when there is more market power. Why? Because there's more of a markup to regulate. Okay, so this does seem to be a factor that the policymakers should be looking at when deciding whether or not to implement the cap, but also at what level to set it. And then finally, we do a bit on this idea of risk-based interest rate regulation. And in particular, what we say is, look, instead of having a flat cap, why don't we use riskers, right? Make them available and let the cap be increasing in risk, which is, we can talk about the political feasibility of it, but to be clear, this is what happens in many insurance markets in the world, right? So this is not like a crazy policy. But I understand the limitations of it, right? So we can do that, and we can implement a simple version of it that is, say, a linear cap that is increasing on borrower risk. Okay, we can try that and compare that to the flat cap, and we can do that comparison for different slopes. Okay, so here in the x-axis I have slopes, and what I'm showing you here is that for a range of such slopes, actually the risk-based cap does much better than a flat cap. In particular, is able to recover a sizable share of the losses in terms of loans and applications. Okay, so the credit access effects are diminished, and also it also recovers around a fourth of the losses in consumer surplus. Okay, and a large share of that comes from bringing risky borrowers back into the market, right? Because we are going to have less adverse effects at the upper part of the distribution of borrower risk. Okay. Okay, so in terms of, so let me conclude. I want to let you go. So I think what we did in the paper is to first, a proof of concept of how interest rate caps may have effects, right? So if binding, they are going to mechanically affect interest rates, but they're also going to likely decrease credit access, right? Part of that is going to come from the mismatch between sophisticated risk pricing by banks and unsophisticated regulation by the regulator. And then often we're going to see that the quantity effect is stronger for risky borrowers. Okay? Then I show you welfare effects. I show you the effects were heterogeneous, combining gains and losses. So there is this trade-off, but it does not always turn out to work in the same direction. So for some people, one force dominates. For some people, the other force dominates. And then overall, average consumer surplus decreases and risky borrowers are the most affected. That's in this setting, right? An advantage of the framework is that we can actually take it to other settings. Then in terms of implications for the design of interest rate caps, first, we saw that market power matters and that in less competitive markets, there's more of a role for these caps, right? But more importantly, this should be part of the discussion. And then secondly, that giving the policy more freedom to account for cost heterogeneity and to adapt to how pricing works in the market is going to allow the regulator to achieve more protection with less exclusion. Okay. So finally, I wanted to close with the two remarks and what I see as a direction for future research. First, the findings are, of course, context specific. We're looking at Chile, which has a particular market structure, and where the policy variation was a particular reform. But actually, the regulation may improve outcomes elsewhere. That's something that the framework allows for, right? We could see that the consumer protection, in fact, actually dominates the credit access effect. We just don't find that is the case in the Chilean context. Okay, and then secondly, we emphasize that there is more work needed to incorporate the behavioral considerations. And so what I showed you today was all implemented using a rebuild preference approach. We know that in the credit market, people may have may face information frictions, choice frictions, behavioral frictions, and accounting for them in retail welfare analysis is a promising avenue of research. I think recent work by Alcott and others is making progress in that direction. Okay. So that's it. Thanks so much. And sorry for rushing in the end. I'm happy to stay, chatting more if there's interest.
Muchas gracias, Ignacio, por esta presentación tan interesante. Tenemos igual, tal vez, tiempo para alguna pregunta más. Así que si alguien de la audiencia tiene una pregunta, por favor, escríbanos en el Q&A chat y le abrimos el micro.
Yo tengo una pregunta mientras tanto. Aquí Federico no. Si entendí bien en el gráfico de los como variando el nivel de concentración del mercado, incluso en el caso en que hay un monopolista, la política no tendría efectos positivos. ¿Así es? ¿Eso es cierto?
Should we switch to Spanish? Or?
Yeah, sorry.
No, whatever is better.
Yeah, sorry. I'm indifferent.
Okay, good. No, I mean, okay, so that is correct. So that's what I'm finding. I don't really take that result super seriously because the model is not a very good model of monopoly, right? Why? Because essentially, so demand is sort of elastic, right? So when the monopoly, when there's a monopoly serving a market, it really has a lot of market power, and it can price up to the price gap, right? So I wouldn't take that too seriously. I also find it surprising, and I expected that line to cross zero.
Yeah.
Now there's no reason actually why that. I mean, what is generating that is still I did look into that, and what is generating that is still the fact that the monopolist is risk pricing, whereas the cap is flat. So if you look at the share of winners and losers and the monopoly, indeed there's much more winners than losers relative to less concentrated markets, which I think is our shared intuition. But I had the same expectation than you, but didn't find that thing.